Gentlemen, we are discussing the best Canadian dividend stocks. Fortunately, the Canadian economy is largely weighted with companies like banks, energy utilities that are the largest market cap, but also pay really healthy starting dividend yields for those looking for passive income today. We're also going to be diving down into my over 300K portfolio to show you how I've structured my dividend income as a Canadian looking for global diverse income from the US and Canada. And luckily, being a Canadian, if you're looking to buy Canadian dividend stocks, you're going to get a tax break even if you're buying them outside of tax efficient accounts like TFSAs and RRSPs, as the Canadian government states that so long as that corporation makes over 50% of their income within the Canadian borders, you're only going to get taxed at a deduced rate of about 15%. Now, if this is a conversation you can appreciate, in return, I simply ask that you hit that like button because we're going to be going over a lot of different companies and see what their current starting yields are in the midst of 2022. Now, taking a look at my own personal portfolio for passive income, I'm generating about $9,646. We can see the big pie on the left here represents the total value of those investments, and this little pie breaks down the income that these investments produce. And we can see I've done a really good job at divvying this up between 50% US and 50% Canadian. Now, I've done this in a way to personally not only make this as passive as possible by buying ETFs, but also to make sure that that income is stable as possible and not as heavily reliant on one economy and one government per se. So we can see the S&P 500 index of VOO makes up 22% of my income. VYM, the US dividend income ETF, makes up another 24% of this income. VDY, the Canadian dividend income ETF, makes up 38%. We have 12% coming from my REITs, about 3% coming from crypto, and of course my savings account where I park some of my emergency fund. Again, on my entire portfolio, this is yielding just over 3%. But if you're looking for a higher yield than 3%, obviously I would recommend, if you're more risk tolerant, to be buying these individual proponents of these ETFs. So let's talk about how you're going to find these stocks and why I always recommend looking at the top weighted companies first and go for yields here, because as most people like myself do not want to take on the risk of buying these individual companies, it doesn't really matter, because as we buy these ETFs, it allocates our money from the top down, because most of these ETFs weight the highest market caps at the very top, the highest percentage holding in the ETF. So for as long as you're looking at these top weighted companies, usually you'll do fine just from people like me pouring money into these ETFs, right? So we can see that mostly financials, we're going to see a lot of energy companies. We're going to be looking at things like Loblaws and a ton of other companies today. So let's kick this off by going through the list of these multitudes of sectors based off their top market cap weighting. First and foremost, Royal Bank. These banks, world-renowned, resilient in many ways, surviving not only the March 2020 crash, but the 2008 financial crisis without cutting dividends compared to their US counterparts. And with Royal Bank having a starting yield of 4.15%, if you could come up with 10 grand, you're going to make $415 annually. If you could come up with 100 grand, you're talking about $4,150 annually, which is pretty beautiful. And compared to Toronto Dominion Bank, both these market caps making up $250 billion, a huge proponent to our entire economy. This one's yielding 4.34%, and both having incredible performance since their inception. A lot of history behind these. But if we dig a little deeper, guys, you can go into other aspects of the financial industry, things like Power Corporation, which are very responsible for investment side of the Canadian financial sector. For example, they do own Wealthsimple, or a big proponent of Wealthsimple, but they also help do financial advisements. Huge company worth $20 billion, paying a 5.8% yield, largely trading off its highs, as this fear of us heading into a recession will freeze up a lot of new investment capital for what they're managing. But nonetheless, these are usually when we start looking at getting into buying opportunities, because the PE ratio is 8.2. You'll also notice most of the Canadian economy trades at a much more favorable value to the US economy, because it doesn't get the same recognition globally where everyone's funneling their money into the US dollar. But we could also talk about things like Manulife. If you're into the financial sector, I don't play around here as much because I don't understand financials, but these things have a very long track record. Yes, you don't get the same kind of growth over its history as we've seen with the banks, but nonetheless, at a 5.83% starting yield, guys, whew, man, if you can get 100 grand in there, you're talking about $5,830 annually, which is a pretty insane starting yield. But let's talk about energy. Canada is one of the most commodity-rich countries in the entire world when we're talking about oil, when we're talking about gold, precious metals, battery metals, even uranium. We are literally recognized to be one of the richest countries in the world based off our commodities. And Enbridge is a very awesome company because it kind of mitigates some of the energy supply. So this is a pipeline company, actually the largest pipeline company in North America, spreading from Canada to the US, and they're responsible for moving energy around. When we're talking about fuels, oil, natural gas, they're getting involved into the renewable sector and don't have the same kind of exposure to, let's say, an oil company that has to drill the oil out of the ground and then sell it at whatever the price is. They're pretty reliant on just us using energy without being, worried about what the actual cost of that energy is to the end user. So this is a pretty great company with a starting yield of 6.19%. And again, it's the third largest company currently in Canada. Now we got Suncor, a direct affiliate to the energy prices. This is a drilling company. This is the company pulling the oil out of the ground that would then again use the energy pipelines that something like Enbridge holds. But this company, I've never been a fan of energy because its commodities are very cyclical. We can see that in the stock price. So I'd only be buying these for yields with a current yield of 4.62%. I wouldn't really be as intrigued, but this is a massive company, one of the largest oil companies in Canada. Now let's talk about utilities real briefly, because utilities, I would argue, have way more stability than the energy sector, because again, this is more reliant on you turning your lights on, and they have a lot of control over what you pay for that, because obviously no one's just going to give up on their hydro bills, or they're very reluctant to unless they want to live in the dark and not have a fridge. So these are very, very awesome companies, with Fortis being one of the biggest at almost a $30 billion market cap, 3.54% starting yield. And I also really like Algonquin Power and Utility Corp, much higher starting yield, a little bit more of a premium here when we're talking about price to earnings, but that also comes to write downs conversation for a different day when companies write down their assets. You'll see this in the real estate sector a lot. It's like owning a car. That car is still going to produce the same income of taking you to work, but every year the total value of the car will degrade over time. It's kind of how the utility sector works. So you kind of want to dig down into these. Don't really trust the price to earnings multiples as much. And you could also talk about things like HydroOne. HydroOne is purely a transmission line company, whereas Fortis and Algonquin Power are more generative companies where they get into utilities with water, obviously generating that from everything from nuclear power plants to wind turbines and solar. HydroOne is purely a transmission company. So kind of like Enbridge with the pipelines, HydroOne purely focuses on the in and out lines that you're paying for. So you can see the lines come into your house. They fix and manage a lot of that, and they're government owned mostly. They spun this off back in 2016, 2015. They became a public company with the government still being a huge ownership in it, but now they've given you, the Canadian user, an actual proponented ownership, if you'd like, to what you're paying. So I feel like this is awesome, because the idea is to own enough of these companies to pay those bills. I've always said that, right? Like, own enough of the telecom providers to pay your phone bill, own enough of the hydro companies to pay your hydro bill, and before you know it, you're going to be financially free. That's the whole joys of dividends. And speaking of telecoms, I mean, it doesn't take a lot of owning telecoms in Canada to pay your entire phone bill. For instance, TELUS paying a 4.69% yield. Guys, think about that. My average phone bill is around $500 to $600 annually, right? So if you could come up with $10,000, you'd be damn near close to actually paying off your entire phone bill. So you need about, I'm going to say 13 to 15K, and you'd never have to pay another phone bill for the rest of your life. That's my situation, which is really cool. I think it's fun to start looking at the little bills first and then buying the companies that can pay those bills, because you'll knock them out a lot faster, rather than looking at a large bill like maybe your hydro or your housing and your rental costs, which would be a couple thousand a month, because you'll feel like you're progressing a lot farther by starting with these kind of companies, right? Like Bell. Bell's another really great one here, paying a 5.76% starting yield. So between TELUS, Bell, you could look at Rogers, but these are some of the largest market caps, Bell being the biggest at a $44 billion market cap, right? So let's talk about something, railways. I mean, this is something that's largely overlooked and is more growth proponented, because the starting yield is only at 2%. But we can see here, guys, over the long term, 6,000% return since the early 90s. This is one that Warren Buffett has bought into. I think the railways are very pronounced here in Canada, because there's a lot of things railways ship that transports can't, when we're talking about fertilizers and very toxic fuels and just toxic chemicals. They usually do it by train, because it's more mitigated in a way from obviously the roads and obviously points of failure in case there was an accident. So the railways have a very good moat that I don't think will ever be disrupted, even though they're saying electric transport would actually be cheaper than railways once we get to that level, is something that Elon Musk, Tesla's talked about. However, railways kind of mitigate a lot of the risk when we're talking about specific shipment of items and chemicals. So let's talk about food companies. Loblaws, some of these Canadian retailers like the Dollarama, these have been very good growth companies when we're talking about being in a recessionary period, because not only do they have pricing power because they can increase the prices, the dollar store, things no longer cost a dollar, let's be real, but people still go there because they have the idea that it's just cheaper. But we can see the starting yield on this one is not that great at 0.3%, but the growth coming out of this has been absolutely fabulous. And same thing with Loblaws, right? During a recessionary period, people will flood into things that are much more stable, obviously being grocery stores. And with a starting yield of 1.35%, again, I would be focused more on these for growth rather than I would be income. Now, finally, what you're not going to get out of these large caps is the real estate investment trust. They're not going to sit in the top weightings because even our largest market cap, Canadian REITs like Cap REIT here, which is something I've talked about many of times, it's a $7 billion company, so it doesn't really show up in the ETFs. So these are the kind of companies I would buy individually. Same with utilities. Utilities don't end up being like massively market capped. So what I do personally is I focus more on the ETFs, and then I start buying the individual proponents like Canadian Apartment Properties or things like RioCan individually, because REITs are almost like diversified ETFs in and of themselves because they're just focused on real estate. So, if RioCan has $6 billion in real estate, you can trust that most of that real estate isn't just going to go belly up as much as a telecom provider like Rogers could just shut off one night and stop operating and then deal with a whole bunch of calamities, which like my phone went out for a single day. You're not going to run into those issues or those risks with REITs, so I'm not too worried about buying them in ETFs. But with REITs, guys, you're going to get much higher yields. You have to be a little bit more careful because they're not tax as efficient, because usually REITs, they're looked at as regular income, so you usually don't get the same tax benefits of buying something like the banks. But because you're getting a much higher starting yield, usually these are good proponents to a portfolio for diversification, right? Now, again, personally for me, I've kind of weighted down. I used to hold a lot of these companies individually, but I found it being much more beneficial for me to own these ETFs like VDY, because they hold all these companies, the largest caps, these high yielding companies, all basically the way I'd like to weight them in my own portfolio, but they take the management risk out because I don't want to have to pay attention to the quarterly earnings. I don't want to have to worry about Rogers internet and cell provider going down. I don't want to have to worry about any of that. So I let the ETF kind of take hold. And if you're worried about fees with something like VDY, I mean, just take a look at this, because the management fees are 0.2%, literally pennies on the dollar here, guys. And the forward yield is much closer to over 4%, but the trailing 12-month yield has been about 3.81%. So you can look at being a reliable yield of around 4%, and again, paid monthly. That's the beauty about something like the VDY, which again just takes the largest market capped dividend payers. So again, with Royal Bank, Enbridge, TD, you're going to see a lot of the energy companies in there, from Suncor to Enbridge, which we just mentioned, but you're also going to get the telecom and everything mixed together. Same thing with VCE if you kind of want the broader Canadian index. So this would probably more or less represent the TSX, also giving you exposure to some of the non-dividend paying companies. So you're going to get things like Shopify as a proponent in here, but they both have similar performance because again, most of the Canadian economy is weighted from obviously a lot of those dividend payers, right? So, but it's nice to have exposure to some of those growth companies like Shopify, which now are trading at a much more premium discount. And this one's only charging a 0.05% management fee, which is much more incremental, about 75% cheaper, but a much lower starting yield at about 3.01%. And again, this one's paid quarterly. So again, if you're looking for dividends, specifically VDY is a great ETF, but I'd always recommend not taking this as financial advice, but just look up the top weighted companies in ETFs. If you like REITs, look up Canadian ETF or REIT ETFs and look at the top weighted ones, because they've done all the homework for you, so you don't have to do that kind of work. And very similar to these ETFs, guys, if you don't want to buy them, I highly recommend just going in and looking at how they weight companies, because it'll give you a very good idea of basically what the best companies are. And it's just a safer way of not having to do, again, all that homework, because most of you are probably pretty lazy. People like the idea of passive income, but true passive income isn't buying individual stocks. It's more or less weighting ETFs. And now I want to pass the question off to you. I'd love to know what you guys think about this conversation in that comment section below. And again, don't get too kind of caught up in these fancier options trading ETFs. I know a lot of people throw that out there and they think they're getting an edge, but typically right now you'll see that those option ETFs underperform the market, especially during recessionary periods, because they only work very well when the market's stable. Options are a whole nother story for another day. Keep your portfolio simple so you can sleep easy at night, and don't get involved in things you truly don't understand. But stay cool, stay awesome, and as always, I look forward to catching you in the next one.